Hello, hello. This is Dr. Rhoades, and we are getting into Project 16 and estate planning, buy-sell agreements, and valuing financial services firms. And into the next lesson, we'll get explored non-compete agreements and the like. First off, you're forming a financial planning firm with two partners. What type of business entity should you be? Should you be a pass-through entity where all of the income is reported down to the partners' tax returns, or should you be a C corporation? Pass-through entities can either be partnerships, taxes partnerships, or taxes S corporations. Right? And the probable answer, in probably 90% or more of the cases, is you ought to be a limited liability company, at least here in the state of Kentucky. It provides the best asset protection because a general creditor of a partner, or in this case, the member of a limited liability company, cannot seize that member's ownership in the interest business in many circumstances and can only obtain a charging order, which basically allows them to share in any profit distributions, and they don't have to be profit distributions. It also creates a potential income tax liability for the creditor if they exercise a charging order. Uh, and that limited liability company can elect to be taxed as an S corporation. A limited liability company files a return, a one-page document with the IRS that says, "I want to be taxed this way: partnership, S corporation, sole proprietorship if it's just a one-person limited liability corporation, or a C corporation, in which a corporation pays tax on its own profits." Here, the reason is to get pass-through tax treatment, including subject to limitations on the owners and their adjusted gross income levels and the like, potentially excluding 20% of the net business income of that company from federal income taxation. So, there could be an exception to that if you desire to grow the firm exponentially by retaining profits in the business and using that cash for expansion. The income tax rates, and you are likely in a fairly high income tax rate personally. Uh, you've started a business with a lot of clients, and you've got a pretty high income from that or other sources. Uh, and you desire to incentivize employees and provide a path to ownership, such as through an employee stock option plan. And both of those, in those cases, you might be taxed as a C corporation. This is quite rarer, at least for startup corporations. In fact, if corporations become much bigger, they can convert to S corporation to C corporation status. It's harder to convert from C to corporation status to S corporation status because you have to go through and we recognize certain income when you do that. Uh, so much better to probably as a startup be a S corporation. Rarely it's a C corporation. Right. If you acquire real estate, an office building, for example, and you should probably do that in a separate limited liability company. Part of the reason for that is you don't want to expose the equity you're going to build in that real estate to the liabilities of the operating firm. For example, if you're a financial advisor and you get sued for providing poor advice, hopefully that never happens, then they might get a judgment against your operating limited liability company, your financial advisory firm, but not against the separate limited liability company holding the real estate. There's some other uh, uh, advantages to that. One is that if you're taking on partners in your firm, they don't necessarily have to buy into the real estate interest. That makes a buy-in by a junior partner especially easier to happen. Also, real estate limited liability companies also get that 20% exclusion on invest income. And if it's taxed as a partnership, probably the last bullet point here is that it permits a stepped up basis. If one of the partners dies, there can be an election to basically step up the basis of the real estate in that partnership, which then leads to better opportunities for uh, the, the that partner's heirs to basically continue depreciation, for example. So there are some tax benefits of holding real estate in separate liability companies, limited liability companies. There's some asset protection reasons for that, and there are also, as we've indicated here, this some significant potential long-term tax benefits here. So let's talk about planning for business succession. All right, let's assume you set up a limited liability company, an operating company, and you're taxed as an S corporation, so it's a pass-through entity and the like, and you have one or more partners. All right. So here are some slides that are basically taken from a financial services firm's presentation. First, it talks about what is business succession planning. Basically, it's how you plan to succeed from your ownership interest out of the business. All right. Businesses, almost half of growing businesses don't have an exit or continuation plan in place, and I'm surprised that it's half. Now, this is uh, a review of 1,485 buy-sell agreements. Basically, 30% do not have a mandatory buyout trigger for death, and 67% don't have a disability trigger, which means if your partner becomes disabled, there's a requirement to buy them out. I'm actually surprised at that because, as an attorney, when I drew buy sell agreements for corporate clients all the time, so I always included those. But I'm kind of it, it's surprised by those numbers. So you need to plan ahead. You need to figure out, all right, if you were to become disabled or die, what is going to happen to your interest in the business? Is it going to pass through to your is it going to be controlled by your family members or the trustee of your trust if you're own that in a trust? Uh, Also, if you have key employees, maybe they're not even owners of the business. What happens if they were to pass away? Like someone is uh, responsible for bringing in a lot of new business into the firm. They might not be an owner of the firm, but they might be so valuable in their role that it's very difficult to replace them. You can actually go out and get what's called key employee life insurance on them in some cases. Um, you certainly want to maximize your financial return. You want to minimize your income tax liability and minimize the risk. And you want to have an efficient transition. You don't want to have a lot of disputes about, hey, I'm going to leave, buy me out, things like that. You really want things to go smoothly. All right. So you have to kind of figure out when are you going to sell, for how much, and to whom. Now, when might be when I retire, and retirement might you might vary the age, all right, or when I die, or when I become permanently disabled for 6 months or more. Those are typical tests, all right. For how much? How are you going to value your interest in the firm, all right? And who's going to buy it? Is it going to be employees? Is it going to be the other partner, or are you going to put it up for sale? Uh, those are all opportunities depending on the type of business that you're at. When will you sell your business? How much longer do you want to work before retiring? I would say this about people in financial planning and investment advice generally. All right, a lot of them will die at their desk. At least in this generation, I know a lot of my colleagues are in their 60s and even 70s, and they are still working because they like doing what they do. They like giving advice. They like being involved. They don't really think, when you take the retirement planning class with me, we basically explore what is retirement. What do you do in retirement? All right? Do you want to stay active? A lot of people want to stay active in the business until they really can't anymore. So a lot of them will slow down and maybe, take a lesser role in the business. But selling a business often happens, especially in financial services firms, when someone passes away. Or in anticipation of that, you sell a business, you maybe merge with a larger firm or something like that. A lot of considerations: your lifestyle, your health care, who's going to pay for your when you retire. Well, fortunately, we have Medicare, and there are other types of Medicare supplemental insurance that we explore in the retirement planning class. What if you outlive your finances? Hope you never do that. Obviously, people are living a lot longer today, and we study that in retirement planning as well. Uh, and the economic climate. Is it a good time to sell a business? It's actually not a very good time to sell a business right now. Valuations are a little bit depressed at the coronavirus, but just in January is a great time to sell a financial services business. And what happens if you have some type of illness or injury that prevents you from working for an extended period of time? So how much will you sell it for? All right. 45% of owners have never had their business valued. I'm surprising that it's that low. It's actually, when have the valuations taken place? 51% within the last 2 years, but 44% in the last 2 to 10 years, which basically says the valuations are not up to date. And probably when looking at valuations being up to date in a business as being like 20% of the time, people just don't get business valuations done very often. One is there's a cost to doing it. All right. So only 5% of the buy sell agreements reviewed reflect a current fair market value of the business at the time of the review. That's very, very common in the world of business. So what's better than saying here is the value of the business is here is how we are going to determine the value of the business. Perhaps it's some multiples of earnings or multiples of profit or some other type of formula that's involved. All right. Basically, the general test for valuing a business is the fair market value. It's the price that a willing buyer and a willing seller would agree to. All right, that's the value that you're seeking to get. And IRS has a very old revenue rolling out. It's 50 years old. Basically, it says consider all these things: financial condition, earnings capacity, and the like, size of the business, and the like. Now, this varies from industry to industry. All right, there's some valuation rules of thumb. All right, dental practices. Basically, a lot of them are sold for like 1 times the annual net revenue or a multiplier of annual net earnings. A law practice, 1 times earnings or less, often far less, because law clients typically don't go to the next. If someone's acquiring a law practice, they tend to not necessarily go. This depends on the type of law practice, but quite often they're undervalued more or less, way less than 1 times the earnings or 1 times the revenue. Accounting is a multiplier of gross annual revenues, which is typically about 1 times annual revenues. Medical, it's a multiplier as well, and real estate, percentage of the gross annual commissions and the like. So there are some valuation formulas that can be used. And in financial services, broker-dealer firms typically get valued at about 1 times revenue, the last year's revenue. So if you own your book of clients, if you own your book of clients and you want to sell that, they basically say how much commissions and other revenue did you get over the last year, and that's the value of your book of business. Now, most registered representatives of broker-dealer firms don't own their book of business. The firm owns it instead. But in the investment advisory space, again, most firms, the firm owns the client. But if the firm were to sell or merge, the value of that might be 2 times the last 12 months of revenue. There's a lot of different factors in that, and you'll see some of that in the readings. All right. Where can you get it valued? Well, there's business appraisal firms. There's investment bankers. If you're going to go out and sell a business and it's worth 10 million or more, you're likely to hire an investment banker for that that specializes in selling small, not really small, but small businesses. CPAs will do valuations. There's a lot of resources that CPAs have to do valuations by particular industries. It says financial professionals here, but I don't know a lot of financial professionals that are really good at business valuations. There might be a few that specialize in it, but I think that's more the purview of CPAs and investment bankers and specialized firms. Even in financial services, there's a few specialized firms out there that will go and do business valuations for financial planning and investment advisory firms. You can influence your business value by increasing your cash flow, basically making your business more efficient. All right. Of course, paying down debt, basically solidifying and diversifying your customer base. If you have one customer or one client that's 25% of your income or 40% of your income, your business is not going to be worth as much because the loss of that one client is too big a risk. All right. Obviously, growing the company and having a good management team in place. There are traditionally 5 common valuation methods. You do not need to know this for purposes of an exam. It's adjusted book value, capitalizing the earnings, excess of earnings, discounted future cash flow, which is studied in Finance 330 and some other financial courses, and a multiple of discretionary earnings. These are the common valuation methods, but again, the actual method chosen varies from one industry to another. Who are you going to sell your business to? You're going to give it to family members, pass it on to family members, or sell it to a family member. The co-owner is often going to buy out the interest because they don't want to work with your other family members, your son or your daughter or whoever. Are you going to sell it to key employees? That's a possibility. You're going to sell it to a third party. All of those things can happen. All right. Most of the time, if you were to become disabled or die unexpectedly, uh, and you have partners, there's going to be a buy-sell agreement. Your partners are going to buy out your business, or your fellow shareholders are an unlimited liability company, your fellow members of that limited liability company. All right. Sometimes you transfer ownership through an employee stock ownership plan, or by varying the compensation and benefits to junior partners of the business. We're not going to study that here. Or obviously you could gift it to a family members and occasionally to charity. Not too common, but there are some people, for example, Dimensional Funds Advisors, founded by David Booth and another person. David Booth gifted $300 million of the stock of Dimensional Funds Advisors to the University of Chicago, his alma mater, to the graduate school of business there, and they named the business school after him, obviously, after that. So what we're going to really discuss is buy-sell techniques. All right, what happens if you become disabled or die? Are you going to basically sell the stock back to the business? Or are you going to sell it to a partner? There are other when you sell to outside parties, it is quite common, especially if you're an S corporation, to just sell the assets of the business. That way, the buyers of the business don't have to assume any unknown liabilities of your business. It's also a little bit more it's less tax efficient for the seller, but it's more tax efficient for the buyer because they establish a new cost basis in the assets. So asset sales are more typical for a lot of businesses when you're selling to a third party. Again, there's an ESOP technique, employee stock ownership plan, that basically allows employees to buy your business over time. It's a good way of doing liquidity. There are some financial advisory firms that have ESOPs. Argy Financial, for example, in Louisville, probably the largest registered investment advisory firm, independent RA firm in the state of Kentucky, has an ESOP that was formed a few years ago. Again, we won't study ESOPs in this course. Gifting to family, a lot of businesses don't survive once they get to the next generation. A lot of them basically are later sold, or they just go out of business. So again, for closely owned businesses, you need to have probably some type of formula to fix the price. And you need to have to say, if I die, my estate or my trust is obligated to sell to my partners, because my partners probably don't want to become partners with my wife or my children. And also, very common in buy-sell agreements is a restriction that basically says, if you want to sell your third ownership of the business, for example, to somebody else, all right, you have to offer that business interest to your partners first. They have the right to basically have a right of first refusal. So whatever the price and terms of that deal is, your other partners have a right to basically buy it out at the same price. And different terms in terms of financing might be established in that case, like paying you out over time and things like that. That basically is a way of, in buy-sell agreements, of saying, We know that we want to be partners with each other, but we don't want any one of our partners to just sell their interest to somebody else, and all of a sudden we're stuck with somebody else's partner we don't want to be partners with. All right. So that's a restrictive covenant placed in there to basically right of first refusal if someone wants to sell their part of the business. Right? And again, fair value has to be achieved. All right. So that's basically all of the things on this video in terms of the buy-sell agreement. There's 24 pages of reading. Don't be too alarmed by it because there's a couple sample agreements there. You don't have to read every word of the sample agreements, but look for some of the key language on buy-sell agreements and the like. All right. Good luck with this project, the readings, and answering the questions. And if you have any questions at any time, please feel free to email me or call me. Just look for any email from me or on Blackboard, and you'll find my phone number and text number or email address. Thank you.